All right, go.
Everyone have one of these?
Yes.
Yeah. Okay. So welcome to the DCF and WAC lecture of WUSIF. So basically, it's kind of a follow-up on the CAPM one I did earlier. How many of you were here for that? Raise your hands. Okay. Here for the CAPM lecture I did last time?
Let the record note that 3 people were here.
Yeah. So you'll have seen this. Have you taken AFM? What? AFM? Oh, okay. So this will be new. Okay, I need to get everyone's names so that I can call on you all. I know you two. You're Angela. Nabil?
Yeah.
Alright. Alex and Jake. Alex and Jake, okay.
My God, it's like Sam.
So basically it's all about how a corporation works. I luckily made really good graphics for you guys. So basically, how does a corporation work? Jake, tell me how a corporation works.
In general?
In general.
They create services or products and sell them to customers.
Right, so they sell them to customers and they get revenues for that, right? So that goes into the corporation. What comes out of the corporation? Let's see, Nabil.
Well, we have expenses for things, so it's products or services.
Yeah, costs, expenses come out. And what else comes out?
Externalities.
Okay, what else comes out?
Profit.
Profits, yeah. So profits come out. That's a big one. So revenues, come in, costs go out, profits come out, right? And so basically the whole point of a DCF is to try to figure out what the share price should be without looking at what the market says the share price should be. So basically profits come out, and based on those profits, you can probably figure out what the share price is. So anyway, who do those profits go to? Angela, you're in 340, so you should be able to tell me.
Some is in a form of dividends, some is as form of retained earnings.
Sure, right? And who do they go to, though? The question is who?
Shareholders.
Shareholders. Who else do they go to?
The government.
Okay, so part of it goes to the government, it's true. That comes out that way. Part of it goes back around, actually. Part of it goes back around into the corporation. I don't have that arrow, but who else does it go to? Shareholders and
Bondholders.
bondholders and debt holders, basically. So it could be banks too, loans, right? So part of it is the bondholders and debt holders, because those people have seniority on all the profits, and then part of it goes to the equity holders. Actually, when we were in Michigan, there was that guy who was a hedge fund manager, a huge hedge fund, and he said that he was talking to Donald Trump because he basically owns the distressed debt. So basically, the debt portion of Donald Trump's casinos in New York, and those casinos were basically not making enough cash flows to cover that part, and so basically the company was technically bankrupt. And so he went into Donald Trump's office, and basically he said, okay, I'm not going to take the company bankrupt. People would lose their jobs. Instead, I'll just take 95% of the profits, and you can have the rest of the 5%. And Donald Trump looks at him and he goes, no, how about this deal? I give you 5% of the profits, and I keep 95%. So just by knowing that debt holders are seniority, you are now smarter than Donald Trump. All right. So anyway, shareholders. And then, so if you have a number of shares, you can figure out what each individual share should be worth. And so that's basically how a DCF works. So basically, it's just a way of figuring out what the share price should be without looking at what the market gives you. Okay, so a firm, as I mentioned earlier in my CAPM lecture, is a generator of cash flows. So in this case, it just generates $100 every year, forever, right? And so how do we figure out the value of it today? What do we have to do? Someone else.
Discount it.
Take a perpetuity. Take a perpetuity, right? At the end, we'll have to do a perpetuity, and you'll have to discount it, I heard, too. So, that's true. Oh, wait. Okay, so first I have to explain what the cash flows are. That's a later slide. Okay, sit down here. Grab a sheet. And so first of all, yeah, let's talk about the actual cash flow. So as on the last slide, as you saw on the last slide, firm, so it is it's going to be the revenues minus the costs, essentially. And so, essentially, it'll be revenues minus costs in this case, or basically cash generation versus cash usage. So this is stuff that makes the firm money, and this is stuff that takes money away from the firm. And everything else will be cash flows. Okay, this is the formula for calculating cash flows. I think normally people focus more time on this, but since it is accounting and it's pretty boring, I'm just going to give you the formula, and then it's on that sheet I gave you, and then you can just do it yourself. Basically, most of the stuff will come off the net income statement. essentially it's a way of taking revenues, taking off all the costs. You'll get the profits, or basically the earnings. This is also known as EBITDA, which is NOPAT. You know, and then you basically take out some other accounting things and you get free cash flow. Essentially, the only trick here is that you take out depreciation before and you add it back in because depreciation isn't taxed. Okay. This is an example of the DCF I did for Chicago Bridge and Iron last year. I showed this example in my last thing too. But basically, you see, you start with revenues, you take out costs, you take out everything else, you take out taxes, and then eventually you get the total cash flows. Okay, so what do we do again with these cash flows? I asked it earlier.
Discount them.
Discount them, and you have to discount them. That's Helen's lecture. What rate do you discount them by? What's your name? Okay, Crunch. Oh yeah, you can't say KSI stuff. I remember. What rate do you discount them by?
The weighted average cost of capital.
Yes, the weighted average cost of capital, which is my next slide. So the weighted average cost of capital is kind of building on what I did last time with the return on equity. And so this is the formula for the return on equity. Does anyone remember what it stands for? Let's see. Nabila, you were here last time. What is do you remember? What is RF?
RF is the risk-free rate.
RF is the risk-free rate. What did I say we use for RF?
3.
Where do you find it?
30-year, 10-year treasury.
Oh,
10-year, 30-year treasury, right? So Wall Street Journal, top row, header. It's over there. Next thing is beta. What is beta? Let's see.
It's the beta of the stock we're doing.
Yeah, so it's the beta of the stock we're doing. So it measures the fluctuation in the stock price versus the fluctuation in the market price. So basically, it says that this is what stocks need to return because stocks are riskier than just risk-free stuff. And so they're actually doing something with the money, so they have to do higher return. And how much riskier are they? They're this much riskier. This measures their exposure to the market. What did I say to use for the RM minus RF?
5.5 or something.
Yeah, actually, I've kind of reconsidered to 6% just so we can be conservative. 5.5, 6%. Put a sensitivity analysis in just in case. Okay, so that is a good assumption for the return on equity. Remember, don't use any other models. This one's fine. Okay, so then there's a separate return on debt, right? So the equity will need to return a certain percent, and then the bonds will need to return a certain percent. How do we find out what the bonds are supposed to return? Anyone? Okay, go ahead.
Well, in general terms, you figure out what a quote-unquote riskless bond is yielding, and then you add on top of that what you calculate to be the risk premium, and you take into account considerations like the credit rating of the company, their past performance and ability to pay off debt, et cetera, et cetera.
Yeah, and so that would be kind of the CAPM method of doing it, which is acceptable. But there's a much easier way of doing that. Namely, most corporations have bonds out, and you can just look at what the yield is on those bonds. Or you could do that if there's no bonds out and try to figure out the cost of debt. Okay, so essentially it comes down to this. So here you have return on equity. Here you have return on debt. And so basically it's just a weighted average. So if you think about like a pie graph type thing, so they're that much percent debt, they're that much percent equity. So it'll be this much of the return on equity and this much of the return on debt.
What's the TC?
And TC is the corporate tax rate.
Oh.
So let me break it down here. Percent equity, right? So it's equity over debt plus equity. And debt plus equity is the total value of the firm. You know, you have the debt, you have the equity. This is the total value of the firm, and the equity will be, well, that'll be the percent equity. Okay. Question?
When you're doing equity, do you use just the shareholders' equity section, like from the balance sheet, or would you use the net tangible assets?
Okay, there's actually, neither of those is right, and there will be a big problem with this later on, as I'll show you.
Ouch.
But there is a way to resolve that. Essentially, if you use the market cap, for example, you have the problem of running into the fact that you're using the actual price in your calculation of price, which you shouldn't be doing. It should be completely intrinsic. And so, and those two, well, shareholders' equity would be doing the same thing, right?
No.
Well, okay, sure, they won't. But there's an official way of doing that. There's an official way of doing that, which I'll show you in a second. Okay.